Now turn to Constellation's financials. From 2021 to 2022, revenue increased by approximately 24.4%, rising from $19.6 billion to $24.4 billion. From 2022 to 2023, the company saw a modest revenue growth of about 2%, with revenues reaching $24.9 billion in 2023. And from 2023 to 2024, there was a decline in revenue of approximately 9.3%, bringing the total to $23.9 billion for the 12 months ending September 30th, 2024. Major contributing factors were increased nuclear output, enhanced performance, and higher output from Constellation's nuclear fleet contributed to revenue growth, particularly in 2023. Favorable market dynamics, including higher energy demand and pricing, positively impacted revenues during certain periods. The introduction of nuclear production tax credits under the Inflation Reduction Act provided financial benefits, supporting revenue growth projections. Variations in energy prices influenced revenue as well, negatively, with declines in certain periods due to market volatility. And improvements in operational efficiency and reduced downtime in nuclear operations also contributed to financial performance positively. The consensus estimates for revenue forecast shows modest growth of 1.2% from FY23 to FY26 at base case without the Calpine acquisition. Revenue surprise compared to consensus has been positive every year, but for fiscal year 24, it is estimated to show negative revenue surprise. Constellation has demonstrated significant growth in its EPS over the past 3 years and maintains a positive outlook for future earnings. In 2022, the company reported a loss with an EPS of minus 0.49. In 2023, a substantial turnaround occurred, with EPS reaching $5.01, indicating a significant improvement from the previous year. In 2024, management's guidance for 2024 is a range of $8 to $8.40 per share, which is up from $7.60 to $8.40. However, analyst consensus expects an EPS of $9.06, reflecting a growth rate of approximately 81% compared to 2023. The 2025 forecast, further, analysts project an EPS between $9.12 and $9.31, representing a growth rate of about at least 2.5% from 2024. Management outlook is that Constellation Energy will target a long-term base EPS growth of at least 10% annually throughout the decade, supporting the nuclear production tax credit from the Inflation Reduction Act and effective deployment of free cash flow. EPS earnings surprise has been negative every year because of fluctuations in energy markets and portfolio performance, variations in operating expenses, including costs related to labor, materials, and maintenance, and they all influence the earnings outcome. Efforts to manage these expenses effectively are ongoing, and changes in interest expenses due to factors such as debt levels and interest rate fluctuations also affected net income and EPS. EPS surprise is expected to be positive over management guidance for FY24. Constellation Energy's valuation metrics reflect strong growth potential. Its profitability and cash flow are expected to grow. However, its high EV to EBITDA and PE multiples suggest the stock is currently trading at a premium due to the premium on nuclear energy stocks that the market has placed due to AI data center energy needs and the Calpine acquisition. Current trailing revenue multiple is $4.20. Its 2024 forward revenue multiple is $4.19 and expected to be at $4.11 by 2026, according to consensus estimates. The EV revenue multiple remains stable, which suggests that investors are valuing the company consistently relative to its sales. given Constellation's long-term power contracts and the predictability of its revenue stream, this is in line with expectations. The slight decline by 2026 may indicate revenue growth catching up to valuation. The trailing PE ratio is 33.1 and is expected to decline to 29.1 in 2026. A high PE of 33.1 in 2024 suggests Constellation is treated as a growth stock rather than as a traditional value utility company. The decline to 29.1 in forward multiple in 2026 signals earnings expansion, particularly from Calpine's contributions and plans to open up new nuclear plants. This remains higher than regulated utilities companies like Exelon, Duke Energy, and American Electric Power Company, which trade around an average of 20 times for PE. The closest comparison of clean energy power generators would be Vistra Energy and NextEra. Constellation is still trading at a premium compared to its peers, so the current price is seen as more expensive. But this also shows that market sees the potential in Constellation and considers Constellation as a growth-oriented clean energy play. Two more metrics to mention are, first, the free cash flow yield. In 2023, it was negative 0.3%. In 2024, the free cash flow yield is expected to be positive 3.1%, and by 2026, increase further to 3.9%. A rise in free cash flow yield to 3.9% by 2026 suggests stronger cash flow generation post-Calpine integration and the price estimates of their current plant power generation sales. The second metric to mention is the dividend yield. The average dividend yield that Constellation has paid out to investors is 0.9%. Common dividend yield that's considered reasonable would be between 1 and 3% if the company has stable and predictable cash flows. So, Constellation's 0.5% is low, but it does signal that they expect to have a part of their business generate stable and predictable cash flow. But as other growth companies, they will be reinvesting their earnings back into the company to expand their nuclear power plants and get into natural gas with the Calpine acquisition. As of September 30th, 2024, Constellation reported cash and cash equivalents totaling $1.79 billion, which increased significantly from $368 million at the end of 2023. Their cash inflow mainly came from their operation, proceeds from NDT fund sales, which is Nuclear Decommissioning Trust Funds. These funds are legally required to ensure that nuclear power plants have the necessary financial resources to be safely decommissioned at the end of their operational life, and they sold investments from this fund to generate the cash. And they also collected DPP, which is Deferred Payment Plan, which is cash received from structured long-term payment agreements where customers, utilities, or counterparties pay Constellation over time for past energy deliveries or infrastructure investments. The risks for Constellation is that if the Calpine acquisition goes through, Constellation will take on Calpine's $12 billion of debt. Given the scale of Calpine acquisition and current cash flows, Constellation's ability to sustain operations without raising additional funds will be limited. The company will likely need to explore financing options to support its strategic initiatives and maintain financial stability. If they raise money strategically and the market receives it well, then they will be positioned to invest in expanding their power plants and secure the customer pipeline in the AI data center energy boom. But if it's done poorly, raising equity could dilute existing shareholders, or raising debt could increase their borrowing cost if their expansion plans are delayed or not met. All in all, the consensus among analysts suggests there is potential for the stock's target price to move higher. Since breaking into new highs in mid-2023, the stock had surged more than threefold at its recent peak. its strong performance has been driven by a few factors: favorable tax incentives from the Inflation Reduction Act, rising forward energy prices in markets like Texas and the Mid-Atlantic, and growing optimism towards nuclear stocks in demand of the data center energy needs, and ongoing industry consolidations, including the acquisition of Energy's nuclear assets and Calpine acquisition for natural gas. Overall, the company remains well positioned as the dominant nuclear player in the US and the newly established leader in natural gas. But following the announcement of DeepSeek, the stock, along with other nuclear stocks, did experience a sharp decline due to a sudden shift in sentiment regarding energy needs for AI data centers. The stock may require additional time to stabilize at a lower level and reestablish its previous trading range before it becomes appealing from a timing perspective. The upcoming FY24 earnings release will be a key indicator of whether the company's recent stock decline presents a buying opportunity.